With the consolidated information, your financial planning can be made easier and more comprehensive. Consent given is set for 1 year, and you can reconsent upon expiry. Get started with SG Findex through your bank, insurer, or My Money Sense today.
Guaranteed 300% returns?
Last day.
Hey, bro.
Last day. Whoa. Whoa.
To see through investment scams, check before you invest.
This shut down when the world will stop without a sound, and we only think about our stuff. Oh yeah.
Financial planning made easier with SG Findex. SG Findex is a first-of-its-kind platform that enables the consolidation of your financial information through your participating banks, insurers, and My Money Sense. It's a secure and trusted platform with SingPass login and customer consent. Just give consent to connect your banks, insurers, and CDP to SG Findex. Once your accounts are connected, you can retrieve information securely. With the consolidated information, your financial planning can be made easier and more comprehensive. Consent given is set for 1 year, and you can reconsent upon expiry. Get started with SG Findex through your bank, insurer, or My Money Sense today.
Good evening, everyone, and welcome to the My Money webinar, Seizing Opportunities, Digital
Guaranteed
Finance
300%
and
returns.
AI.
Last day.
Thank you for joining us. We've got a great program for you tonight.
bro.
We're going to start by taking a look at how markets are right now. Followed by that, we're going to look at some of the digital tools and platforms that are available to you. And after that, we will be looking at the investment platforms available as well. And finally, a panel discussion with all our speakers. If you'd like to ask them any questions, please do scan the QR code on the screen right now. So if you scan it now, you can stay on that page for Pigeonhole because you'll be able to submit your questions at any time. And very importantly, you're able to also vote for the questions you want answered the most. We will try our best to get through as many of your questions as possible at the panel discussion in the last half an hour to 40 minutes. So please do scan this QR code right now so that you can ask our panelists questions later on. Also, the Basic Financial Planning Guide has been released, and this is a massive effort that has been very long in the making. A lot of hard work has gone into it, both on the public and the private sector. They've worked together to make sure that this is a guideline, a good framework for everyone to follow in order to manage your money better. So to find out more about it, scan the QR code on screen right now for the Basic Financial Planning Guide. It tells you some very useful information for yourself to plan your finances. For example, emergency funds. Have at least 3 to 6 months. Protection, which is insurance. Make sure that you're covered for critical illness, at least 4 times annual income. Death and TPD, at least 9 times annual income. Make sure your shield plans are covered. And also, on top of that, try to aim to invest at least 10% of your income for your retirement and other financial goals. If you're 55 and above, maybe you should look into the options you have, one of which is to monetize your property. Start your retirement planning now if you're 55 and above. And importantly, this is for everyone, not just for the young or the old. Make your will and your CPF nomination. This is so important because it gives you peace of mind. It allows you to sleep well, knowing that your loved ones will be taken care of in case anything happens, in the very unlikely event, of course. It's really just part of making sure that we have everything sorted out so that we can focus on the more important things in our lives. So scan the QR code on screen right now to find out more about the Basic Financial Planning Guide. Okay, I've talked a lot already, so let's kick off today because we have our first speaker who is a very familiar face to many of you. He will be giving us an overview of how markets stand right now. If you're signed up to the SGX newsletter or the SGX Telegram channel, you already know him. He is the market strategist for the SGX and also one of the most astute stock market analysts I know. Please welcome on screen, Mr. Jeff Howie. Jeff, you're on mute at the moment. Can you just come off mute, please?
Yep, I think I unmuted, and the screen should be up there. I'm good to go. Thanks very much, Edward. Thanks for the kind introduction. I hope to take 15 minutes, no longer, obviously, because we have a great fun-filled night ahead. And of course, everything I'll be presenting is from an educational perspective. What I'd like to talk about really is what markets are doing right at the present time, just as Edward spelled out. And I think the most important takeaway is that at the moment, markets in Singapore, stock markets, not just in Singapore, across the region, have increasingly and determinedly been looking towards 2024. And this month, we had the IMF maintain both Singapore and ASEAN will see growth acceleration in 2024. And the IMF sees Singapore's GDP growing by 1% or so this year, maybe a little bit less, but then doubling up to 2.1% next year in 2024. And this is in line also with the ADB, Asia Development Bank forecast for Singapore to achieve 2.5% GDP growth next year. And it also parallels the MAS's survey of professional forecasters' mean expectations for next year as well. IMF expect that ASEAN 5 growth will accelerate from 4.2% this year to 4.5% next year. But the bigger, broader picture is that while Europe is also expected to see growth acceleration in 2024, China, Japan, and the United States are expected to see growth deceleration. So while the ADB did last month forecast that we'd have 2.5% GDP growth in Singapore next year, with 3% inflation, that bigger, broader picture does matter, and that 2.5% GDP growth rate was actually a 0.5% revision downwards, and also that 3% inflation rate was a 1% revision upwards. And the rationale for this is pretty familiar with investors, and that is weak external demand and tighter financial conditions that have a moderating effect on growth, not just this year, but into next year as well. Breaking it down for Singapore, the Asia Development Bank see weak manufacturing continue to drag on growth. However, the acceleration in 2023 comes from supposedly robust services, the sustained expansion in construction, which is based on a sizable pipeline of government projects. They explained that this growth in services sector will be supported by continued improvement in trade services, information and communication, and a robust tourism industry. At the same time, though, on the forewarning side, loan growth in financial services may feel the pinch from the ongoing tighter financial conditions in the US. These were also some of the main takeaways from the advanced third quarter GDP report released a couple of weeks ago, just short of 2 weeks ago in Singapore. And while non-oil domestic exports were down 13.5% year on year in September, making it 12 months of year on year contraction, what is actually supporting the low 2% to mid 2% GDP growth projections for Singapore next year is the World Trade Organization maintains that global merchandise trade volume growth will actually accelerate from 0.8% this year up to growth of 3.3% in 2024. And this matters for Singapore. Singapore's total trade of exports plus imports is 3 times larger than the global average, 4 times larger than the average in Asia. That's according to IMF. And while Singapore's GDP ranks as 30th largest across the globe for merchandise trade, we rank the globe's 16th largest exporter and the 16th largest importer by value. And this is obviously because of that crucial role that Singapore plays in both regional supply chains and re-exports. For instance, in Singapore, we import some machinery, we refine, we work on the intermediate product, and then we export the intermediate product to another country before that equipment does eventually finally reach its final buyer. But still, overall markets have been increasingly looking towards the big picture in 2024. There has been an air of caution, though, since the end of the second quarter earnings cycle. You can see that in the performance of the benchmark index here. It's for a 4% total return for the first 8 months of the year, and then has declined 5% over the past 7 weeks. And that's very much like the region. The regional benchmark, FTSE ASEAN Extended 60 Index, has seen a total return of 4% as well over the first 8 months of this year, and then seen a 5% decline over the past 7 weeks. So moving quickly along, interest rates are obviously in the frame, as we said, those tighter financial conditions, and two of the most interest rate sensitive sectors in the Singapore stock market are banks and REITs. The trio of STI banks make up 45% of the STI, and they have begun the third quarter 23 reports today, with UOB providing its third quarter business update. Banks also make up some 20% of our overall Singapore stock market capitalisation, in addition to around 20 to 25% of the combined ASEAN market capitalisation. Here in Singapore, banks make income from net interest income and non-interest income. For the Singapore trio of banks, net interest income generally makes up around 2/3 of their total income, and that is, of course, that difference between what the banks pay on their liabilities to the difference to what they receive on their assets. And the higher the overnight policy rates, the generally higher the net difference, particularly when that year-on-year growth in the rate hike cycle was commencing. The trio reported combined net interest income of 8.3 billion in the second quarter of this year, and that was the third consecutive quarter that their combined net interest income was reported above the 8 billion mark. For context, the combined quarterly net interest income of the trio broke above 5 billion Sing dollars in the first quarter of 2018, and pretty much ranged between 5 billion Sing and 6 billion Sing on a quarterly basis for just over 4 years, right through to the first quarter of 2022, before breaking above the 6 billion mark in the second quarter of 2022. The STI banks also led the net institutional fund inflows to Singapore stocks in the third quarter, and the 3-month compounded SORA remained pretty much around 3.7% during the quarter. So much attention in these third quarter earnings and these business updates, as we saw today. Really a number of issues, but one in particular, how the outlook for growth does impact the low single-digit growth forecasts that have been earmarked for 2023, as well as what forecasts for loan growth in 2024. So as I said, a number of areas that the investors are looking at, and loan growth is one that's pretty high on the list. On the REIT front, 70% of the market cap of global REITs is actually in the United States. So there's a very big tidal effect on the global REIT market with what happens in the US. And the US Fed Reserve's Financial Stability Report, the most recent one, was on Friday night, and they signaled that there's increasing concerns about inflationary pressures potentially leading to restrictive or more restrictive monetary policy for longer, and that prospect of large losses in residential and commercial real estate. So REITs still account for close to 20 cents in every dollar that goes to work in the Singapore stock market every day, while they represent around 10% of our total market capitalization, thereabouts. Diversified REITs also now make up the largest subsegment of the S-REIT sector, and the S-REITs are also diversified as to where in the world they are investing. We've got, I think, just 3 REITs that are investing purely in Singapore now. And just to digress a little bit at this stage, because it's really relevant to tonight's topics, data center REITs, they have flagged generative artificial intelligence applications like ChatGPT and Bard as industry subdrivers. Singapore's largest data center REIT by market value does maintain that continued expansion of the hyperscalers, the growth in consumer and enterprise activities, and the adoption of cloud computing and digital transformation initiatives, and of course AI, can also provide support and and supportive demand for data centers. And according to JLL Research, the rise of AI will bolster demand for data centers worldwide, with the rise leading to increased data usage and improved computer efficiency, with JLL Research also adding that rapidly expanding data needs are seen to accelerate growth and drive investor interest, even as headwinds do actually persist. And some of those headwinds, as we said, have been on the trade front. So in addition to 12 months of Nordics contraction, exports have also been in contraction for the same period of time in South Korea, as well as Taiwan. And we've also been in contraction for 12 months in our industrial production, with both exports and manufacturing outlooks somewhat hinging on the demand for electronics in China. Paralleling our supply chain networks and our regional trade channels, SGX lists now close to 90 stocks that report more than half their revenue to China, and another close to 90 stocks that report more than half their revenue to ASEAN, excluding Singapore. And while posting similar growth rates this year, the perception of overall economic resilience of ASEAN has also seen the ASEAN contingent of Singapore-listed stocks see just less than half the declines of the China contingent of Singapore-listed stocks. And we're at an interesting juncture too, because there were some very mixed results from the official SIPMM PMI and the S&P Global ASEAN Manufacturing PMI for the month of September. And thus next week will be important to see if that marginal expansion by the official SIPMM was an aberration or maybe a green shoot. The Singapore industrial production for September, which was released today, did come in at the second narrowest contraction for the past 12 months. So all eyes will be on the screen to see if that expansion that we're seeing locally by the local survey is actually sustained for the next month. We have a iEdge Singapore Manufacturing Index that's also in the red for the year to date, and it's pretty much been in the vicinity of those average declines for the Singapore, the ASEAN, and the China contingent of stocks that we list here on SGX, I mean by a revenue perspective. So the manufacturing index also, it's interesting that not just 20 cents in the dollar that goes to work in the stock market every day is going to REITs, but there's another 20 cents in the dollar that's going to work in our manufacturing sector. So these are around 110 stocks that also make up around 17% of the total market cap of Singapore. And they represent 8 different sectors with relevance to the 6 key clusters of Singapore's industrial production. So obviously you've got electronics and precision engineering there, biomedical and pharmaceutical, transport engineering, chemicals, F&B, as well as general manufacturing. And like Singapore's industrial production, transport engineering resilience has extended to the transportation-related manufacturers in the year thus far. But much attention is on the technology side of the index because of where we are in the tech cycle, and also previous forecasts, because to the point that this latter half of the year is supposed to be near some type of inflection for the cycle. However, more recent guidance suggests that the inventory glut is expected to continue through to the end of the year. So SEMI, the big industry association, noted last month that softening chip demand and elevated inventory of both consumer and mobile devices have contributed to the 15% decline in global fab equipment spending in 2023 for the front-end facilities, but is also, SEMI still maintain that that is expected to rebound by 15% year on year to just under $100 billion in 2024. And longer term, most semiconductor associations do project semiconductor sales to be in the vicinity of $1 trillion a year by 2030. And that's up from the Semiconductor Industry Association gauge of $575 billion for last year. So because of where we are, this has actually seen the pendulum moving to the right some weeks with some stronger momentum, but then moving back to the left and taking back some of those gains in other weeks. So that contingent of semiconductor and hardware stocks has obviously been in focus in the market. And there's also the drive for the region to digitalise, because there's a few a few sort of long-term structural drivers for Southeast Asia and ASEAN, such as digitalisation, sustainability solutions, and of course semiconductors, particularly for Singapore and Malaysia, that are very relevant to the stock market too. And one key ASEAN structural growth theme, as I said, is that drive to digitalisation. So our 5 most traded stocks, they provide services that span financial services, telecommunication services, and travel services. Together, those 5 stocks make up a little over 1/3 of all the combined trading activity, so around 33 cents of every dollar that goes to work in our stock market. And of course, Singapore does rank as the 8th largest exporter of digitally delivered services across the globe. So that's interesting. If the G7 was actually built on the exported digitally delivered services, we'd be just outside the G7. So digitalisation has also played a key role in the service delivery of these 5 stocks. Obviously, many of the banks, the 3 banks customers, the majority are digitally exported, digitally enabled. Also played a key. You've got Singtel maintaining its growth engines of NCS, its data centre, and its digital banking businesses they are growing in scale, and it's got its newly created standalone infrastructure unit, Digital Infraco. And Singapore Airlines themselves, they have developed a series of digital solutions that have, as of May, and we'll get an update soon, has basically saved 500,000 staff hours as it is. I just want to speed up because I don't want to overrun. So I'm very near the end. Wanted to talk about the sustainability side of it, although I won't go into it too much because this is a pretty important theme. For the broader market here in Singapore, we've had sustainability reporting on Singapore listed stocks for the data-driven decision makers in place since 2016. On the infrastructure front, to achieve sustainable development goals by 2030 and to be at that net zero emission mandatory level by 2050, significant investment in sustainable and resilient infrastructure is required. And the OECD actually estimated that $7 trillion per year is needed up to 2050 for infrastructure investment in infrastructure to meet the development goals to create the low carbon, climate resilient future. Multiple Singapore stocks have been pursuing strategic pivots to provide sustainable infrastructure and more fuel efficient transportation and offshore solutions as well. And actually, within the energy sector, there are pure play climate solution providers such as renewable energy companies, and there are power generation companies which no longer add coal-fired generation capacity and only build new renewable energy projects. So for the renewable energy providers, it's really important to understand how gigawatts work. Gigawatts is the key metric, both in terms of operational capacity and the renewable energy assets under developments. And the assets, renewable assets, are typically solar and wind, sometimes hydropower as well. So on the renewable energy front, unlike conventional energy, renewables is not base load, does not generate electricity 24/7. Obviously for solar, the sun goes down and we have nighttime. The power generation really depends, therefore, on the plant load factor of the renewable energy assets, such as irradiance levels. But as an indicative guide, and as I said, this is all in the spirit of sharing education. If the plant load factor is around 15% for a solar asset in Singapore in 2022, and assume that SP Group HDB average flat consumption rates, then typically or indicatively, 1 gigawatt of power could power over 270,000 4-room HDB flats in a year. So that's where that's one important gauge on the energy providers front. But there's also the other heavier industries such as shipbuilding, where companies may be increasing the clean energy options across their product range and pivoting their revenue base away from the more carbon intensive products. So importantly, investors are able to then access and extend, the extent, I suppose, of the cleaner and the greener options by assessing the portion of their share in the total order books. So all this information is, of course, available for investors on the SGX corporate announcement pages. Coming to my very last slide, status quo obviously remains an outlook of uneven and slowing global growth on the back of the tighter financial conditions, the challenges in China real estate, and geopolitical concerns as well. In addition, big year for 2024, you have big elections in the US, India, the EU, as well as Russia. And on the tech front, AI has certainly captured market headlines, and the title of tonight as well, and probably brought many investors who are really looking forward to me finishing the next 2 minutes so we can get to the AI and the digitalization topics. But it's also somewhat exacerbated a little bit more of the fragmentation in the tech sector so far this year, rather than really bring a broad bid tone like 5G did back in 2019. Singapore's Article 4 consult back in August, it noted that given the risks of deepening geo-economic fragmentation, Singapore should diversify trade markets and continue to implement structural reforms to transform Singapore into a knowledge-based, innovation-driven economy. So this was the advice from the IMF when they did their annual consult. But for what we've got here is our information and communications sector, which has steadily grown to 5% of Singapore's GDP last year, and it has continued to grow year on year for the first quarter, the second quarter, and the indicative advanced reading for the third quarter, and also support tech enterprises. Singapore is making significant policy efforts to strengthen the global interconnectedness of its digital economy. It's looking to increase investments in technology innovation for R&D, for translation efforts, and creating good jobs in the information and communications sector. So I might actually leave it here and appreciate everybody's time. And now, as efficiently as possible, I will try and stop my sharing and so forth. Okay. Don't seem to be, yep. Okay, stop. Thank you.
Thank you very much, Jeff. So folks, Jeff will be back later on, and if you have questions for him, please do submit them through the QR code on Pigeonhole. Please do submit your questions and vote for them as well. So coming up next, investing doesn't have to be hard. You just need the right tools to help you find the best ways to put your money to work. Our next 3 speakers will share with you how to level up your investing using fintech tools. And you'll be surprised at how easy it is to get started and how easy it is to access and utilize these tools. Sharing this with you will be the Executive Director and Team Head of Investment Products Management, Consumer Banking at DBS, Mr. Jonathan Yap. Over to you, Jonathan.
Thank you very much, Edward. Good evening, all. My name is Jonathan Yap, and I'm currently the Team Head of Investment Products Management at DBS. So today I'm going to be sharing with you the enablement of digital services to enable financial planning as well as providing solutions for investment decisions. Just bear with me. Okay, so briefly, I'll talk through how digital services can be used to power up our business capability, and then discuss how digital services can be used to enrich content on financial planning capability, and then the utilization of open banking via the SG Fintechs. And then I'll move on to talk about the financial planning tool, to discuss retirement planning and investment solutioning, and last but not least, to give you a flavor of what constitute the digital investment services that we can potentially use today. Okay, so I've got about 10 minutes to do that, and here we go. So the slides that you're looking into right now looks at the enablement of financial institutions as they embrace the power of digital services. So a lot of us would know that the accumulation of market conditions, typically in a volatile environment, culminating in the need for technology innovations via the AI capability would enable us to drive product development to manage volatile markets, as well as to enable us to provide capability to meet the demands of our customers. a lot of the digital services that you see today can actually offer a 24/7 cost-effective solutions and support to our customers. And some of the examples of how digital services can be penetrated, if you've got the right capability, is that it can provide you personalized recommendations via AI intelligence to understand how you can make your money work harder for you. It allows you to anticipate what you need before you actually need them. And other things that it does is, if you've got upcoming payments or irregularities listed in your accounts, the capability of digital services will actually prompt you with real-time alerts. So you can go in there into your bank account and to look at, what are the areas that requires further attention. So overall, digital services actually enables us or enables financial institutions to create much more improved customer experiences and then helping retail investors to manage and grow their wealth. The enrichment of content within digital services can actually empower our consumers with knowledge. Knowledge is power. Insights knowledge would enable the engagement between the financial institutions as well as our customers or our consumers so that they can take actual baby steps to develop good financial habits. The digital services enablement with the power up of content would cover 3 basic criteria. Number 1, the financial literacy that a digital services can provide would actually assist for consumers to understand the basics of financial planning. For instance, right, if you want to understand the impact of inflation and interest rates on your financial well-being, then there are potentially content that you can refer to. Or if you want to start to get onto the financial planning ladder, there are also steps that you can take to embark on your journey. There are also tools available, the financial planning tools that you can use to plan further ahead in terms of how you can track your savings and spendings with the bank's app, or in fact, how you can even plan your finances entirely online with the app. So all these capability can be managed within the intelligence of an app. And then last but not least, if you expand the financial literacy to cover family matters, then it comes in very handy, particularly with young couples wanting to understand how they can manage their monies together, or even young parents who want to plan for finances right now and also in the future. So the capability of the content empowering knowledgeable experiences and insights to consumers are actually critical to success to actually start to commence on your infant stage of your financial planning lifestyle, and then moving on to the more complex matter. And I'll go through that as we talk about the other enablements. So today, thanks to SG Findex, Singapore Financial Data Exchange capability, we have an open banking environment. The open banking environment within Findex, SG Findex, which essentially is one of the world's first public digital infrastructure that captures your national identity following your permissioning, and then it allows the centrally managed online consent to be able to connect yourself to the intermediaries, which includes your lending partners, the insurers, the governments, the investments, capability and deposits within the banks, as well as other financial institutions. So effectively, the connectivity between your personal financial matters that are being aggregated across all the different financial institutions comes into the play, right? So you've got the FIs, you've got the government agencies, etc., etc. So if you look at these middle diagram here, you actually have a capability where today, SG Findex actually comprise 15 participating FIs, right? But to understand your overall financial health and how you manage your personal balance sheet, it provides a consolidated view on a single digital financial planning tool of your choice. So the middle diagram shows a very brief indicator of how initially, as you plan your financial planning journey, you accumulate your wealth, up to a certain retirement age, and then leading to, I guess, decumulation strategies where you eventually will retire, and then you needed to be guided by the financial planning interactions, because the tool that you use would enable you to manage your retirement capability. So on the right-hand side of the slide, there is an option to use a NAV planner, which is a tool that enables you to basically look at all the financial information into one place. As I mentioned earlier, it shows you the cash flows, the ins and the outs, and then the budgets that you require to manage your day-to-day funding capability. So financial planning tool enabling of our one topic that we actually don't spend a lot of time looking into, which is retirement, the retirement strategy. So this is an example that I'm drawing to provide the capability of a tool that helps you to project your cash flow view at retirement, right? So the table A to the left-hand side shows a representation of someone at the age of 74. If he wishes to undertake certain expenses, let's say up to the value of maybe 2,000, right? The tool would enable him to understand his monthly cash flows requirements that will be managed by, in this particular instance, the 2,000 basic expenses will be managed by the CPF life payout when he's 74 versus the SRS payout versus the cash. And then on top of that, he's got lifestyle expenses, the need to manage the additional lifestyle expenses and the investments that are required to help him manage those lifestyle expenses. So it's a nice constructive view of how you can actually manage your retirement, particularly during the cash flow sensitivity period, as we all start to retire. And then the table B on the right-hand side gives you a projection of the retirement income per se. So if it breaks down your retirement goal to a monthly view, it gives you a projected investment income. Let's say if you need 4,500 per month as you retire, and if your basic expenses can accumulate up to 3,000, and then let's say your lifestyle expenses is 1,500 or 2,000, immediately you probably see a potential gap there as you retire. And the beauty of this tool is that leveraging again the SG Findex and then your cash savings, etc., you would need the tool would actually help you explore investment opportunities in terms of what are the additional amount that you need to save for a period of emergencies to help you mitigate towards the potential excess spending when it comes to lifestyle changes. So this is a very important framework that one can take into consideration as you manage your retirement. More importantly, the tool for this particular enablement, it also provides action cards that can be generated as a prospect of your retirement engine capability. And therefore, it consistently tracks your personalized action points in terms of what do you wish to achieve and how do you wish to manage your savings and investments to eventually help you have a much more enjoyable retirement when the time comes. Financial planning tool also delivers investment solutioning via an app. So on the left-hand side is an example of a DigiPortfolio app where it takes basically $100 Singapore currency to start off with. There's no lock-in period, very low fee. It's managed by season of portfolio managers, which align to the house views, and it creates a 100% integrated options being managed and fulfilled internally within the construct of the portfolio. It also enables regular market monitoring and the portfolio rebalancing, leading to eventually the optimization of the portfolio. So for most novice investors, the $1 million question is, do I do it myself, DIY, or do I leave it to the experts, which is the DigiPortfolio tool? Well, I've listed a couple of options where we can examine the pros and cons of DIY investing, right? The pros is obviously you know what you want, and to know what you want, you have to have a bigger ticker size to be cost efficient. Otherwise, it eats into your portfolio costs. But again, on the con side, it's actually time consuming to construct what will be a decent portfolio for you to have without further investing and researching into the right areas. And obviously, there's also potential concentration risks if you put all your monies into one basket. Alternatively, if you were to look at portfolio solutioning that can be delivered via an app, then the diversification of risk comes in, right? How potentially a portfolio that's been managed on your behalf can look at ways in which we diversify a portfolio so that your risks of having concentration criteria within particular stocks is being minimized. You can do bite-sized investments, and it frees up your time. You leave it all to the potential robo-advisory capability within the app. Obviously, the cons is that it's less customizability from your angle, but you also need to be mindful that if you go into portfolio solutioning, you probably need to set some monies aside on a monthly basis in order to help facilitate some of the auto transfers so that it doesn't fall away unknowingly. Last but not least, I think from a digital investment services capability, it's actually very simple choices that you can use to facilitate decision making, because all you got to do is the tool should be self-explanatory. You all just need a simple click to get it started. You can look at different currency options. One particular tool looks at Singapore dollars versus USDs, and then obviously your risk profile, your risk versus your returns comes into consideration. So some of the tools within a digital portfolio consist of diversified portfolios for the exchange traded funds, ETFs, or unit trust funds, and this funds actually offers regional or global exposures, right? So it also consists of your capability to earn passive income, if you would, out of the combination of returns that can be generated through portfolio of income, where equity and bond funds comes into consideration. Last but not least, optimizing your savings, as I mentioned earlier, and to do that, the combination of having diversified portfolio with a combination of good mix of equities and bond funds, together with high quality fixed income funds, will enable you to hedge those risks and make decent returns for you to be able to grow your capital. So I've come to the end of my presentation, and thank you for listening.
Thank you very much, Jonathan. Much appreciated. Thank you, Jonathan. It's so hard for us to figure out what to do with our money exactly, and some great insights from you there on how easy it is for all of us to use things like DigiPortfolio and SG Findex to plan for our own future. So if you have queries for Jonathan, please do submit them using Pigeonhole. You can scan the QR code on screen very soon. And I actually see that there are some questions there already. Remember, you can submit questions, you can vote for them as well. There's something there about SG Findex for him. We'll definitely ask that question to him later on. But next up, now, you may have heard people talk about robo-investing platforms in the last few years, but what really is a robo-investing platform? To help us learn about this, we have the Managing Director of Wealth Management, Wealth Advisory, Global Consumer Financial Services at OCBC. He has over 2 decades of experience talking about the markets and investing into banking clients, and we're pleased to have him today. Please welcome Mr. Aaron Chui.
Thank you, Edward. Let me share my screen. Good evening, everybody. I'm Aaron Chui, Head of Wealth Advisory at OCBC Bank. All right. I think this is definitely a good segue into, how easy it is to use robo-advisory in our daily lives, and how prevalent the technology has kind of advanced, and it really makes things a lot easier for us, that in the past, technology wasn't that available, but with today, with handphones, they're like mini computers, and you can access to a lot of different tools that really aids us in what we do. And if we take a look at what are the common features of robo platforms around within Singapore, and it does cover a very wide variety in terms of products, services, and with that, it really be able to make it easier for investors to construct the portfolios, at the same time keep track of market news, and at the same time have an overview of your financials. So with that, I quickly then moved into the what are the common things and where investors can really achieve. And I want to very easily touch upon diversification and why it is important in what this does for you. A lot of people kind of have a mindset that when I invest, I want to first of all invest in what I'm most comfortable with, and that is important. But at the same time, one should also look upon as how do we then use technology and the features available in robo-advisory to create that diversifiable a portfolio so that you can spread out your eggs in that basket and potentially reduce that portfolio risk. But at the same time, I'm very well aware of the market construct where geopolitical risk is right at our doorsteps, whereby you have the Israel Hamas conflict right now, Russia-Ukraine is going, and that continues to bring that systematic risk that you cannot reduce this risk even via diversification. But nevertheless, with all of this in mind, it is still pretty important to know that while market risk cannot be diversifiable, but it can still reduce that portfolio risk through the various instruments to reduce the impact on each and every one of these assets. And hence, where I'm coming to is that it is important to then look at robo-advisory platforms, whereby they do offer multiple instruments made available, and that can help you construct very easily without much difficulty in being able to identify those risks. And we are referring to instruments like, for example, stocks and ETFs, bonds, commodities, REITs, unit trusts, and even portfolios that's kind of governed with AI in it as well. So with all of this construct, the correlation between each of these asset classes tends to have a slight deviation, and with that together, you are able to quite easily create that portfolio for yourselves. So these are the few things to think about when it comes to how easy it is to construct the portfolios. Now, at the same time, where I would like to advocate upon is that robo platforms do cater for different type of investors, and it ranges from beginners all the way to seasoned. So beginners, these are low barrier of entry. You have very easily managed portfolios designed for you so that it suits you without having too much of a knowledge, and you can sort of leave it to the operation of the fund managers or the robo-advisory to be able to construct that management day-to-day of the portfolios. And it'll stretch all the way to seasoned investors who keep track of the markets to know the flavors of where the macro insights continue to change, and to be able to create a particular portion within the portfolios that goes into thematic portfolios. And that gives you a lot of different types of flavors using the various themes and sectorials to be able to construct that. Or it could also fit into different life stages of investors, where they're also looking to build upon an income portfolios, whereby you can construct using a portfolio of bonds, of REITs, of equities that pays dividends, with the various type of instruments produce a regular stream of income for you. So it really depends on where you fit in, but basically robo-advisory is for everybody. And with that, it then comes to the next portion of choices. What do we exactly battle between digital versus human? So let's go on to the traditional side of things, whereby while we think about robo-advisory, whether will it be able to replicate and replace humans, or some may beg to differ, because at the end of the day, there's still a lot of market sentiments as market sentiments remains unpredictable, and hence there will also be available whereby traditional fund managed unit trusts, overseen and managed by expert investment managers, will be able to calibrate that as the market conditions change and market sentiments are being incorporated in how they manage those portfolios. And if you go back to the new age of digital, today, of course, technology is constantly improving and changing, but today when we talk about digital, we're currently referring to proprietary algorithm-based recommendations where they will basically streamline and aid in terms of selecting the instruments, selecting the assets to be populated and manage risk of those portfolios. So it's really a matter of choices between digital to human or even combined of both. And that kind of choices are easily made available using robo-advisory. So when it comes to building a portfolio with what you believe in, and I think that's important. So first of all, for easy investors, we always talk about building of core portfolios. When we talk building of core portfolios, we then talk about risk-based portfolios. Depends on how you perceive the risk threshold that you can absorb and accept it. So for example, a lot of people kind of mention that, I want to make the best return, but I don't want to take the risk. While we all know that is not entirely possible, typically in a very higher risk type of instruments, it usually becomes more volatile. So hence, having the risk tolerance truly to what you can accept, I think that's important. So with that calibration of the diversified risk-based portfolios, for example, are you talking about balance? Are you a cautious investor? Are you a defensive? Or are you really looking at growth or even aggressive portfolios? With that calibration of portfolios, you can have that as a construct of your core base. You can also complement that depending on the different stages of life, as I earlier mentioned, about income portfolios, whereby if one is looking towards growing the capital, or you might want to tilt towards an income portfolio as a base, and that's a choice between investors. And if you move to the right-hand side of the picture of building your portfolio, when you have more or less constructed your core portfolios, whether it be growth or income or risk-based, you may also want to kind of look upon the markets and think, where would you want to add additional value, additional alpha to your portfolios? And with that, you can talk about a thematic strategy, for example, metaverse, impact investing, Gen Z winners, US tech leaders, cybersecurities. Many of these are also available within the Robo Invest with OCBC as well, whereby it's worked very easily when one construct that, say, okay, now I want to allocate a certain portion to incorporate some of these thematic portfolios within my portfolio to boost the additional value of alpha within the portfolios. Or at the same time, when I look upon the markets as being more defensive, I can also then tilt down some of this thematic to a more defensive nature as well. So with that, it gives you a lot of flexibility for the investors to be able to maneuver even as conditions of the markets ever change. And with that, it's also important to then look upon technology available as one look upon with regards to how do I then keep track of the market? There's so many news all around, and different platforms will definitely be able to offer you the market insights. At OCBC, what's interesting is we also have these market news and insights whereby it's all constructed all within the portfolio, within the app, whereby, and then this is also available in many different robo-advisory as well, whereby they do offer the kind of market news and insights whereby you can still get access to, read about it, find out what is the ongoing market conditions, and make the decisions in terms of how do you want to manage your portfolios accordingly as those market conditions change. And I also want to mention that it is very important to also pull data from all the different banks and resources so that you have it all in one place. Having the financial one view to be able to synchronize that and collate all the financials across different banks, insurers, it allows you to then have a judgment call on how much are you spending, how much are you saving, where's your excess cash, so that you can properly deploy on a systematic approach so that you are able to allocate those finances to continue to grow money and do those goals. So hence, the financial one view is also pretty easy to once you synchronize, you're able to have a very good construct to make those investment decisions. So with that, I kind of concluded my portion here. And let me then stop sharing. Yeah.
Thank you very much, Aaron. That is a great primer on robo-advisory services and also what OCBC has to offer. And if you have queries for him, please do submit them, because last but not least, we've got one more speaker for you now that we've learned about robo-investing platforms from Aaron. Why would we choose to use one? To help us answer this question, we're very glad to have one of the pioneers of robo-investing in Singapore. He's a 22-year veteran of the finance industry with expertise in quantitative methods and cross-asset investing. Please welcome the co-founder of Stashaway, Mr. Freddie Lim.
Thank you, Everett, and speakers before me for the very comprehensive introduction and overview. I just want to housekeeping if my screen is showing up all right, if somebody can indicate it. Okay. Hi, thank you very much. So, hi, my name is Freddie. I'm a co-founder of Stashaway, Singapore's first digital wealth management platform that launched in July 2017. We operate across 5 countries today, ranging from Singapore, Malaysia, to Hong Kong, Thailand, and Dubai. Just very briefly, in terms of I'm just checking my screen, sorry. Yeah? Edward, let me know if my screen is moving. Okay, thank you. Now, just take a step back. What is a robo-investing platform? First off, it is an automated investment engine that helps savers to do the following. We tend to help you plan and set financial goals. And this is very important because your goals determine the time for your investment. So if you have a retirement goal that's 30 years from now, obviously your investment time horizon is going to be 30 years. It's very important because this is very different from, say, you want to buy a home and make a down payment in 3 years' time, because a 3-year horizon versus a 30-year horizon determines that you cannot take a lot of risks with the 3 years because you have less time to recover from unexpected shocks in the markets. So time is actually very important. The second piece of the puzzle that robo-investing platform tries to solve is to assess the risk profile and tolerances of the individual investors in question. Everybody has different background and hence risk tolerances. So that is actually an extremely important parameter in most platforms out there. And 3, finally, with the time in mind and the risk in mind, we try to build and maintain diversified portfolios for you. Now, why the picture on the right-hand side is not too robotic, but instead it looks like a safe, like a vote, is because I feel that, with digitization, with AI and all these very, very hot topics, one should not forget that we do have responsibilities to be safe. So most robo-investing platforms, we do spend a lot of time on cybersecurity. Beyond cybersecurity, there's also standards like, tech risk management protocols, and also who do you choose to partner with in terms of, the custodian banks that's holding the assets separate from the robo-investing platform. So the safe is a very important part that we try not to forget. Now, core value propositions in summary for robo-investing platform. Number 1, the intelligence, the analytical bit, it is being more and more focused on. In most versions that when we started 6-7 years ago, automated reinvestment of dividends is a given. Auto rebalancing of our portfolios when different assets are changing in market values, so you need to return them to your target allocations. That is also pretty much automated across the board in most players in the industry. Asset allocation goes huge and optimizing your portfolios on an ongoing basis to make sure, like a sportsman, you take a briefer review and stay in optimum condition. So same thing as a sportsman, re-optimization is very important. So intelligence aside, flexibility is also a very key bit. Users can set multiple financial goals. Each goal can have a portfolio, so you can have multiple portfolios. You can make recurring deposits. You can make flexible withdrawals. There's no lockup period. As in most traditional fund products, lockup period is quite a standard feature, but most robo-investing platforms do away with lock-in period. No hidden fees. Obviously, consumer does demand a lot of transparency in this space. And lastly, cost efficiency, because technology, in theory, hopefully in practice, does empower and allow the robo-investing platform to operate efficiently, and that reduces costs and hence fees versus the more traditional institutions. Moving on, a question I get a lot from people is that, we used to talk about digitizing everything, making everything more nicely interfaced, more convenient to use. But today, with the shock that came earlier with generative AI, we get this a lot. What's the impact of artificial intelligence on the financial industry? I would like to clarify, number one, it's not about trading better. It's not about making better speculation or trading decisions or even long-term investment decision. It's not about that. At today's level of sophistication, it's not about that yet. It's also not about replacing human financial advisors. AI actually is very focused on bringing faster onboarding. You don't have to talk to someone anymore. You don't have to fill a lot of forms. You don't have to call someone. You now can, through very simple steps, through MyInfo, through uploading an info, through Findex, information sharing. It's all this making digital products easier to onboard clients. That's number one. It also augments advisory because the ability with generative AI is actually making it easier to have a customer support more empowered, to be more productive, to talk to more customers, to actually curate content faster and on a more massive scale. So we used to have very annoying chatbots, and today that's gone, right? So number two, very nice feature to have. But what's more understated is number three, AI can enhance fraud detection, can also police behavior better, and in particular in the RegTech, regulation tech area, it does enhance compliance. So not just a robo-investing platform, but fund managers or even the banking institutions now have a more powerful tool in terms of compliance and fraud detection. That's actually a very, very big thing. And number four, which is still debatable in my point of view, is I have a mixed opinion on number four, which is that AI is going to make complexity of building a portfolio, optimizing a portfolio, maintaining a portfolio now just simply automated. I think that remains challenging to do well, but there are evidences that the AI can actually do that quite well for medium and long-term portfolios. For more tactical stuff, you do need to be a lot more cautious. And finally, what we do at a little bit of feature of the features on StashAway's platform, very briefly, you can see on the left picture, you can build a plan. You can set a goal, and so for example, here I've chosen goal-based investing because I always believe that when you invest in something, you need to have a clear target why you invest. It's not just to make money, but make money for what? In this case, you can choose stuff like planning for retirement, and that's a 30-year portfolio. Buying a home, that could be 3 to 5 years, depends on your aspirations. paying for your child's education. That can be 10, 15 years down the line. So the go time is very important here, as I mentioned before, and that's sort of tackled with this template. Moving towards the right-hand side, which is more about portfolio construction. You see here, I apologize for not using a Singapore dollar example, but we have a ringgit example here because we operate across countries. Here, once a user's risk profile has been dissected and understood and agreed upon by the users, the algorithm will start building a portfolio across asset classes around the world to try to give you not just diversification, but to also show you the breakdown of your portfolios. So on the rightmost side of it, you see, wow, in this particular risk profile, you have 20% in commodities, you have 55% in equities, and so on and so forth. So it's quite transparent because you can click and expand those little arrows, and you can see even deeper what's going on inside equities, what's going on inside commodities, what's going on inside fixed income, right? And of course, it takes some long-term projections to help you do some financial planning. If you save so and so much per month over 30 years or over 5 years, where you're going to be. So that's a mirror picture of that. So in a nutshell, these are basic features, but there are also other features such as multiple portfolios, customization of portfolios. You can now easily say, I disagree with you on China tech investments. I want to change that particular portion. That's doable today. And the resulting risk will be flagged to you once you make that change. And obviously re-optimizing your portfolios for the future. So in a nutshell, it's getting more and more interesting, more and more options, more and more cosmetics as well. So it's all getting fun. Back to you, Edward.
Thank you very much, Freddie. So, folks, it's really nice that all these platforms do try to speak our language to help us identify what we're investing and planning for. So now we're going to bring Jeff, Jonathan, and Aaron back on to join us now for the panel discussion. Please do submit your questions for them. We'll do our best to answer as many as we can. I'm going to start with this sort of thought model for all our panelists because we're talking about AI. And in the Bloomberg Tech Summit earlier this week, they talked about these three things. The loom, which 2 centuries ago, the Luddites destroyed all these weaving equipment because they were terrified that it would replace weavers, that this technology would replace people, so they destroyed it. So that was the loom. They were scared it was going to replace people. The other thing is the slide rule. That's the second thing. The slide rule allowed human beings to measure things precisely, much more than we could just by estimating, okay? And the third thing is the crane, which allowed human beings to do things that we never could, even if we had infinite amounts of time, like lifting a 30-ton steel bar up 100 meters. We can't do that. We need a crane for that. So which of these is AI? Is it a loom? Is it going to take over all these jobs? Is it the slide rule? Is it just a really good tool to help us do things more precisely, better? Or is it a crane that will empower us to do things we never could before? So keeping this thought model in mind, I'm going to start with Jeff. Jeff, your thoughts on AI?
Yeah, it's an enabler. It's not something that's going to crush employment levels. It's something that is enabling efficiency and productivity. I think that's the key message, Edward. We need AI and we need super fast, super chips in order to have automation in vehicles that are, basically having autopilot on scary, hairy roads, where there's no lighting and so forth. You obviously don't have it in Singapore, but elsewhere in the world. So I think it's more part and parcel a incredible technology development that obviously has consumer applications, and we need it, to be honest. I mean, it's basically taking Google to the power of whatever it is, 10 or 100 times better than what it is in terms of, the functionality. But I do think you don't lose sight that this is about much more than replacing jobs. It's actually part of solutions that we need, particularly, as I said, on the infrastructure front as well. When you consider you have 7 trillion or 6.9 trillion US dollars of infrastructure spend between now and 2050 to get the world into net zero preparation and net zero ready, we need these applications. We need to get much more bang for our money. We don't have the money to afford it. Basically, the world's got to find a way to basically grow within and increase the curve and use these chips for better productivity. As I said, not just from a consumer and entertainment and leisure point of view, but also critical for workplace and infrastructure development. That's what I said.
And thanks, Jeff. And from a climate point of view, we can't afford to fail. We absolutely cannot. Jonathan, I'm going to come to you for your thoughts on this. AI, what do you think?
I'm going to try and, thanks to Jeff for his contribution, but I'm going to try and answer this a little bit differently, maybe making it a little bit more fun, because AI, like it or hate it, it's all about creativity, right?
Yeah.
So whilst traditional AI looks at analysis, decision making, being able to do more for less, then we have the new and latest generative AI that is a lot more creative, and produces things that has never existed before through machine learning, reinforcement learning, and it requires a lot of brain power and excellence to take us into the new frontier. So then as we move to the new frontier, then if I'm a fortune teller, I'll carry a crystal ball, right? The generative AI can actually, and also AI can also predict the future. Because while Gen AI can spot patterns and combine them through the utilization of different forms or models, AI is more predictive, but it uses historical data, as we all know, whereas generative AI uses the capability to combine unique new forms. And then last but not least, I guess, traditional AI is more about how we can accomplish ourselves using algorithm to make graphs, predictions, and automated actions. But the importance of generative AI is that it uses more complex algorithm, maybe with a combination of deep learning and larger language models. And to do that successfully, you're going to need bigger machines, right? But then going back to the original question, I think AI, in my humble opinion, will never replace humans, because you need humans to be part of the brain to build the AI foundation. And that would be my fun bit to
That's a very cool point of view.
describe AI.
And also about innovation as well, the possibility that we can use it to think in ways way beyond how we could if we didn't have it. Thank you so much for that. Aaron, I'm going to come to you. What are your thoughts on AI?
It's definitely interesting, and in terms of how AI has developed. And in fact, internally we have actually developed an AI model called Oscar, whereby it actually we sort of have a machine learning process. It took us 3 years to kind of map, and we took some of our top brains within the organization, ex traders, fund managers, and we sort of replicate, in these various scenarios, what are your thoughts in terms of how do you then feed in all the various data and how will you react? And then we pick on their brains on different scenarios and we kind of train it into the model, and so that the model can pick stocks as if it's them picking the stocks. So we trained them, it took a long time, and the questions then evolved into, will this potentially eliminate and remove our jobs? and the answer is no, at least at this current junction point in time, partly because there's a constant repositioning of how, as a market environment do change, each individuals will then re-look at more variables and retrain back into the model. And so humans constantly being inputs is constantly being required to tinker between the machine learning so that it can continue to pick up as market conditions change. And this continual process is an ongoing, but what is interesting is it definitely helps us to scale our productivity. Meaning to say that in the past, it would have taken us a couple of weeks, days, and now it's done in hours. To scale a combing through of thousands of securities. So that is definitely a revolution for us in terms of how we deploy AI, machine learning, and back together with the human brains to replicate this cohesive working order so that it benefit mankind. So that's something that's revolutionary. Yeah.
Thanks so much for that, Aaron. It's like what Kathy Wood from ARK Invest said. She earlier this year in an interview, she was asked about AI, and she said the secret superpower of AI is actually productivity. It helps us. It's a great tool. It multiplies our efforts. Thanks for that, Aaron. I'm going to come to you, Freddie. Your thoughts?
Thanks, everyone. Very interesting. Leaving me a lot less to say. I think, in summary, it's a blessing to those who's willing to use it to improve your own productivity. It may be a challenger to someone's job as well. New jobs will be created, but if you happen to be in those jobs that can be disrupted, then you need to make an adjustment. I think a personal example is great here. I was trying to code in Python 2 days ago, and I'm not an expert in that. I was trying to code something called random forest algorithm with extreme gradient boosting, whatever that means. I did it within 5 minutes, and the ChatGPT wrote a draft. It didn't work because it always made low-level mistakes. It sometimes imagined answers, but the truth is it saved me a lot of time, because that amount of structure and the code that I need to write in the past could be 2 days, but it's available there in 5 minutes. And with a bit more prompting and patience and interactions, it's getting towards a better answer. Or a code reader like myself, look at it, I can spot low-level mistakes made by ChatGPT. But because of that background, my productivity massively, exponentially improved. But it also means that I may need to fire programmers in the future. So it's give and take. It's going to be challenging. It's also going to be very productive. I'll leave it here.
You probably, well, there's still going to be a job for the prompt engineers, I think, the ones who know how to make the AI work for you. And it's fascinating what you just said, GPT-4. It's made what would normally take a day or two's work. It's reduced it down to 10 to 20 minutes. So that's incredible. That's phenomenal if we think about it. And I think this is, thanks to the four of you for your opinions. This is really going to move us forward. Let's go to your questions, folks. Your top voted question, I think this one, I'm going to start with Jonathan for this, because I think this one is for you. The financial planning ecosystem may sound cumbersome for consumer who has not embarked on their financial journey. How to ensure that we don't miss out on any critical components of the ecosystem? Jonathan.
Wow, I really need ChatGPT 4.05 for that to answer that question. Financial planning ecosystems is huge, right? When you talk about ecosystems and how it can be encapsulated within a financial planning strategy. Maybe to make it a little bit more simpler for our audience, within our organizations, we build our financial planning framework around a very simple, easy to remember acronym. And that acronym is called SAILOR, right? How do we sail across our financial journeys so that we can optimize financial planning to be able to deliver, and create wealth, for our customers. So the acronym SAILOR, S stands for savings, right? Do you have emergency savings for those rainy days? Do you have the MAS recommended 3 to 6 months of savings to cater for the unexpected in the future? A stands for assurance or protection. Typically, this is where your insurance policies comes in, etc. Do you have any dependents that requires a certain coverage, and are they sufficient to weather against future contingency risks, right? And what are the protections that are required for various stages of your life? And then the I is for investment, right? So what kind of investors you are, we went through a few examples just earlier, and what is the right investments versus your risk and return appetite. And then collectively, you can also look at L, which stands for liabilities management. So this looks at your loans, your borrowings, and your dues, and how do you go about managing them. So putting the S, A, I, and L together, how do we then use the O to optimize for the eventual retirement stage, right? So when do you want to retire? How much do you want to expect to spend when you retire? And this actually helps to project your retirement, as I went through the slides earlier, before you can suggest any actions that you want to take to meet your retirement goals. So if there's anything you want to take away from this question, ecosystem is huge, important. To understand financial planning requires financial literacy and content and information, but the sailor, hopefully the sailor model will guide every consumers through and weather the storms in the future.
Thanks so much for such a comprehensive answer, Jonathan. And to our viewers, we want to encourage you also, if it feels a bit overwhelming, you're like, it's quite a lot. I didn't manage to take notes. It's okay to ask for help from a licensed professional. They're out there. They can be happy to help you. You can DIY, sure, but also seek advice. There's nothing wrong with that. Look for the right people to seek advice from. Next question, I'm going to go to Freddie for this one. So Freddie, this is a question. We've got a bunch of votes for this. Is AI today able to make safe, and this is important, safe and sound investment decisions without human interference? And I want to give some context to this, because 14 years ago when I was a banker, we were worried that the quant desk and algo trading was going to take over our jobs. But here we are, 14 years later in 2023, and we're still here. So is AI able to autonomously and independently make safe and sound investment decisions, Freddie?
The short answer is not easily. And the people who has that ability, if their AI design has the ability, they're not telling us. So most of them are not going to tell you. So let's leave it at that. But in terms of AI making investment decision is somehow a very elusive target at the moment for most institutions. It's actually easier to go to space and navigate the entire universe, James Webb Telescope, Hubble, what have you, analyze those data. The universe that we are in is actually more deterministic, more structured than financial markets, sentiments, animal spirits, and what have you, right? I think the greatest challenge is logistic. If you look at it, ChatGPT's data ends at December 2021, if I'm not wrong. It costs too much money to keep scraping data every single minute because new data are constantly coming in. And that muscle, the machine that the server casts is either going to make the world go bankrupt at the moment or ESG incompatible, because the amount of energy it's going to consume will be more than Bitcoin. So please, I want to say that everyone, please don't just chat for fun all the time, because that is an environmental impact. The amount of data centers we're going to see, yeah, you want to buy data center REITs for the long term, but the amount of data center requirements, the amount of heat generated, amount of energy consumption. If you think Bitcoin is something, this is on an entirely different scale. So I don't chat lightly with ChatGPT for that reason. I also don't chat lightly with ChatGPT because it's going to suck in my IP. Because you have some creative design, it's going to learn from you as well. So don't forget that. Use them wisely to do work for you. So I won't go on further because there's a lot to talk about, but I'll end here.
Thanks for the reminder, Freddie. Very important. Yes, you can, folks, you can delete your ChatGPT data, and you should. All right. And perhaps be more judicious about your use of prompts. Aaron, I'm going to come to you next, because this is a question about market conditions. It's very risky now. High inflation, weaker growth, investor confidence is in the dumps. Aaron, why should I even be investing or thinking about investing today?
Exactly right. I think we are in a very uncharted territory, that we are for far too long in a low interest rate environment. And with this, of various geopolitical tensions, you have heightened inflation that continue to be persistent, even though it's been coming down, but it still remains pretty sticky. But at the same time, technology has kind of perverse in a certain way that, one of the questions will be, why should I be invested in this kind of market conditions today? Whereby, how will technology help in terms of making my life easier? So with that, I think robo-advisory across various platforms has definitely, first of all, made a lot more solutions available for investors to choose from. Today, one can then think of two things. One is a lot of the bad news is known today and is being priced into the market today. The question is, I think, Jeff has also earlier mentioned that IMF have kind of forecast that next year it seems to be potentially not as bleak compared to where a lot of investors are thinking about. So having connect the dots whereby a lot of risk has been pricing in today, and if some of these risks kind of perceived as not as bad as it is, potentially these risk premiums that currently being priced in may potentially lift some of these prices, which means to say that today it is very difficult to then say that I don't want to be invested, because one must bear in mind that we are still continue in an environment whereby inflations continue to erode the value of cash. So hence, staying invested remains important. I guess the next part then to think about will be, how do I go about investing, and how does robo-advisory helps me in that process? And I think that is a relevant kind of a positioning whereby, despite of market conditions being risky, investors today can still be very easily look upon what's suitable for individual, whether be it, you can set aside a more defensive portfolios, and many of these robo-advisory platforms around within Singapore do offer a lot of choices whereby one can then scale down those risks by choosing more defensive portfolios, and then once they're more comfortable, dollar cost average into those positions, and then let time do the work to build these positions and grow their investments to achieve their financial goals. So yeah, I think we are in a good shape right now.
Thanks for that reminder, Aaron. It's very important to remember, folks, you don't have to lump it all in at once, okay? You can bring it in month by month, just a little at a time. You can start from as little as $100.
Exactly.
Right? That's just $3.30 a day. Can one, all right? You can start small, but it's still very important that you start. And speaking of wanting to start, Jeff, I'm going to come to you. This question is about starting to plan for their finances, because they say financial planning requires as much discipline as training for marathons. Small steps go a long way. What advice, Jeff, would you give someone who's just started planning their finances? They're just starting out. Jeff, you're on mute.
You're on mute, Jeff.
Let's see if Jeff can get himself off mute. It's okay. We'll let you fix that, Jeff. We're going to come back to you. Not to worry. There's another very big question. Jeff, we're going to come back to you for sure. Jonathan, I'm going to come back to you on this one for this question next, because there's quite a few people asking, is it safe to connect my data to the banks using SG Findex? Because you mentioned that earlier. How is my data being used by the banks? Jonathan, you're on mute. Thank you.
So, is my data being safe? Okay, so ultimately, consumers would need to be providing consent to respective banks on an annual basis. So if no consent is being given, then there'll be no retrieval of information, right, from the platforms and tools perspective. The other thing to remember is that the SG Findex, it's a government-handled platform, right? So there are stringent security models that are being used to safeguard your personal data that passes SG Findex, right? And one also needs to remember that SG Findex platform, they don't actually store your personal data. They only transmit the information between the intermediaries, right? Through your permissioning. And all the data that's been transmitted are also encrypted. And then last but not least, you're going to need SingPass for authentications and authorization. And insofar as how the data is being used, as I mentioned earlier during my presentation, it helps us form an aggregated view of our financial situations. But then it also provides services that are really relevant to your needs, your financial planning needs. But most important, you actually get a holistic view of your financial status. And it actually does go a long way in helping you to shape and achieve sound financial planning.
Thanks very much for that, Jonathan. So folks, the government, especially the MAS, has agonized over this very question. And I think we can be assured that if you worry, our servants even worry. And those worries and the pressure they put on the private sector as well, very extensive. So I think we can trust it. That's my thoughts. We'll leave it there. Jeff, we're going to come back to you on this question. We're starting out investing. Baby steps, first steps. What should we do?
I think it's education, and education is the one thread that really, I mean, from what Jonathan was saying about savings, assurance, investment, liabilities management, optimize, hopefully retiring. Yeah, it's just so common. Or what we were saying too about diversifying, concentrating, do you dollar cost average? You need to be educated in Singapore, not to find a good company, but to be in good company. Because I do think that the retail investors in Singapore generally are pretty smart. Then they don't chase comets. If you look at since the end of 2019, we've had retail investors in Singapore net buy Singapore stocks to the amount of close to 14 billion Singapore dollars. So that's in less than 4 years. And the majority of the buying, the biggest year was in 2020 when the STI lost 8% in total return, when global stock markets were up around 15%, 18%. So you can see that's not really attuned with chasing comets and chasing overshooting markets per se. It's more about deep value investing. And it's the same when you look at last year, we were up 8% in total return. The rest of the world was down 15, 16, 17%. That year, we saw the least amount of net buying by retail investors, only 300 million Singapore dollars thereabouts. So far this year, they've bought about 2.3 billion of stocks in net buying. So I think, as I said, to be in good company for retail investors, I do believe education is really important for this market, and it's a really important sub-branding of this market that investors generally are well educated. And there's some great simplified approaches there. I mean, the Saylor approach is a great one, dollar cost averaging, and the ability to try and attempt to mitigate that timing risk that goes in with doing the lump sum. The common thread to all of this is be educated, and this is exactly what Money Sense is about.
Thank you so much for that, Jeff. We've got time for one final question. This is for Freddie, for Aaron, and for Jonathan. I'm going to ask you to answer that in this order. I'm going to start with you, Freddie. This question is a big one because this viewer is asking that a portfolio, a digital portfolio, or robo-advisory portfolio, is it constructed by a human or by a robot, an AI? What happens if the actual returns are very far from the advertised or expected potential returns? Will there be some intervention by the regulators, or do we blame it on bad luck and poor decisions? Freddie, I'm going to let you start with this one.
Firstly, whether it's robo or human fund managers, past performance is not indicative of future performance. It sounds like a disclaimer, but it is true. Now, the difference is how we move forward. AI or machine learning or anyone with analytical models, there's got to be data. You got to base it on the past. It's just how you want to approach it. Is it a smarter way? Like AI can say, I want to slice and dice the data in a certain way. In the past, when we have a higher inflation, in the past, when sentiment is this way, I can look at the data and slice and dice and say, I have a higher chance of success because I can say, I can make a better educated guess. Now, where it's really important is not whether returns deviate from target, but whether the loss versus the risk are they in line. You told your user you are a certain risk profile, hence here's the portfolio. So you say that there's 1% chance of losing X amount of money. Here we are, we broke it by 3 or 4 times, then something is wrong. So that investment process needs to be reviewed. So there's always going to be a role, at least today and in the near future, there's a role for someone like me looking into it, the investment committee looking into it, people looking into it. But I also going to say I designed it and it was manual and then I had my answers. The machine will very quickly have its own answers and we compare notes, right? So there are a lot of cases where there are in audience data assumptions that they do actually have human-machine interaction on a day-to-day basis. It's not like we just take it at face value. That's my version of the answer.
Thanks very much, Freddie. So yeah, so at least at Stashaway, it's a hybrid. There's always someone, there's always a human being or a group of human beings actually taking a look at it. I'm going to ask for the OCBC view, Aaron. On your side, how do you work the robo-advisory platform and how's it put together?
That's a great question, actually. So robo-advisory, a lot of investors kind of misconstrued that, the machine takes over. And we're not at this junction whereby the machine takes over exactly where Freddie has mentioned. It's still a constant hybrid between humans overlooking the machines. Yes, we have input a certain set of data, we have feed it with a certain set of data, and at the same time, we have put in the algorithms, the machine learning aspect of it to then maneuver and select those portfolios and the asset allocations and selections of those assets. And then we'll constantly then have it to be reviewed to ensure that it's delivering what it does. But I think back to the same question, right, that there are so many different types of portfolios as set out.
Yeah.
So if one is being positioned as I want to invest into a growth portfolios, so what it literally means is that the security selection of that portfolios literally picks the assets that within the framework. The framework means that these companies are growth companies. So what does it mean to be growth companies invested in current market conditions? And that's where I think it's very important to then bounce back to, at least constantly have an eyeball on where the macro market's conditions, which stage are we at? Are you invested, even though you want to grow your portfolio, you are an aggressive investor, but then one would probably need to ask this, is it time to be invested in growth? Or do you think that you would like to, if you're not so comfortable with the current volatility, maybe pare it down for the current moment, and once you're comfortable again, nudge it back up again. So it's really a comparison of an equivalent of what are you asking for? I mean, because if you select a growth portfolio, one may not expect the growth portfolio to suddenly become very conservative and then go back to a very high growth. There might be certain models of such, but most of the models tends to behave in what you would select it to be. And hence, one would then need to do that calibration. But of course, out in the financial world, there are calibrated portfolios, but they're usually slower to react and they're slower to adjust back again. So it really depends on the choices of how you construct that portfolio, of where do you want to position that call, and then based upon a continual updating from what the market's conditions are, maybe do some slight adjustments in the reviews, and that will still help. And robo-advisory has kind of made a lot of these solutions quite easily available so that you can still interchange within it. So that's how one should still have an eyeball on overall things.
Thanks very much, Aaron. It's so important. It's like what Jeff said, you need to be educated. Educate yourself. Don't just blindly follow it. Know what you're getting into. Final word goes to you, Jonathan. On the DBS side, tell us a bit about how your robo-advisory platforms work.
Thank you for me to take that question at the end. I guess Aaron and Freddie has taken some of the thunder from my role. But so to for consistency and completeness, we are somewhat similar, right? So I would answer those questions without repeating what Aaron and Freddie said. From our perspective in DBS, we look at a hybrid combination, right? So if you want to have diversified portfolios that are supposedly resilient, and if you don't want to put all of your eggs in one basket, then we look at a hybrid of human versus the technology element, right? So we do have all our portfolio managers sitting in the back room, looking at smart, constructive way of how we can capture opportunities and perform the rebalancing. And obviously, with the use of technology to be able for us to scale a lot more quicker to provide the optimal asset allocations. I would also try and tackle the second questions, which is the more sensitive questions. But to do that, I'm going to come up with another acronym, just because it's coming to 9:45. So the acronym is CAR, right? So in DBS, we heavily practice CAR, which is customer account review. So without reviewing the customer account, you can never open up this portfolio to trade, just to protect our customers. And then if I don't know how to spell CAR properly, it becomes a CKA, right? CAR, right? Which is customer knowledge assessment, right? So if you marry the two together, you really need to get to marry the two together to get through the door for you then to be able to do DG portfolio, as simple as it sounds. But most importantly, always read the small disclaimer, right? Trade at your own risk, but not others.
Thank you so much for that, Jonathan. So important. And it's important to know yourself. Yes, exactly what Jonathan said. Know your own preferences for investing, know your own risk tolerance so that you can sleep well at night and not have to worry about your investments. That's all the time we have, I'm afraid. Once again, I'd like to thank our wonderful speakers, Mr. Jeff Howie, Mr. Jonathan Yap, Mr. Aaron Chui, and of course, Mr. Freddie Lim. And thank you to all our viewers for joining us this evening. I hope you found the presentations and discussions useful. If you liked this, please do follow Money Sense on their social media platforms for more great events like this one. And scan the QR code that's coming on screen to let us know your feedback so we can deliver even better events for you. We look forward to seeing you at our next event, and here's wishing you a successful investing journey ahead. Good night.
Thank you all. Bye-bye.